Hey, welcome back to the channel of Data I Financially Follow. And as always, this is just for educational purposes. Always talk with your advisor on anything that you see here or, additional questions that follow on. This episode, I think, is going to be not one for all the masses, but it's going to be really case specific, and it might be something that you are thinking, maybe you're experiencing, or something that is coming up in your parents' lives or grandparents' lives. But it's an important conversation to have, and it sneaks up on us before we know it. Planning for long-term care. What happens when we're old, and who's going to take care of us? Dementia, Alzheimer's, senility. I've fallen and I can't get up. I need someone to take care of me now that I've had a stroke. Or we've just gotten to the spot, progressed in our lives, where we just need to have that skilled nursing facility. These are all different ways that we come into long-term care. Not mutually exclusive to that list, but it happens. Not a hospital stay, not a quick surgery, but our daily activities: bathing, dressing, eating, your medication, getting you around. All these things kind of factor into, long-term care. There's a couple different ways that we pay for these things. Behind door number one, insurance. Though to pay for long-term care insurance while you're in your 30s might be not as prudent as we would expect, but probably a lot of cost savings there. We typically tend to start recommending this around age 50, because now we're starting to get to a spot in our lives where this is going to be really more relevant for us. Once we get older, the cost of insurance is going to go up, because insurance is based on probabilities. Insurance loves statistics. If I am a 30-year-old person, is it likely for me to get dementia? Probably not that likely. If I am 65 years old, is it likely that I am going to get dementia? Well, from here to there, I would say there is a stark increase of how quickly this is going to amp up the cost of insurance, because it's more likely that we're going to need to tap into it. So around in their 50s is a really good time to start, talking about how we're going to plan for long-term care. That way the insurance isn't so extremely cost prohibitive. Behind number two is, can I just pay out of pocket? Yeah, if you have the resources. In California, middle of the road long-term care is like around $100,000 a year. And it's projected to grow at 4% a year. So if I have $100,000 now, and by the time I need long-term care, that $100,000 might need $400,000. That's a big jump. Do I have enough to pay for my retirement and to fund a long-term care insurance event? I don't know. We'll find out. We'll talk about some ideas when we get to that section. And number three, family. Great, mom and dad, they need help. I got an extra room, we move them in. But that comes with its own pros and cons too. That's not as clear cut as we like to make it out to be. So going back to door number one, insurance. Insurance can be really cost prohibitive for a lot of people. They see it as it's like another mortgage. Then it's going to have its own set of terms of how many days they're going to cover, how much of that they will cover. But the idea of insurance is that we hope to never have to use it. It's there in the background in case we have to tap into it. But if you ever had to tap into it, you're glad that you do have it, because it helps protect your savings. It gives you more choices when this event happens, and overall reduces the financial burden to your family. Cons are going to be the premiums. Feels like a second mortgage. Depending on when you get it out, the rates can go up. You eyeballed it 5 years ago, it's going to be not the same as it used to be. And if you never needed it, you're going to feel like you just kind of wasted those funds. Though there are some policies that do have some kind of premium payback in the form of a death benefit. So there are some different things out there, and insurance products are a dime a dozen. Definitely shop the market. Don't just go with one insurance agent and call it a day. Feel free to take that quote and go apply it to others. Using the same kind of variables, like, okay, great, if I got it from this person, then I can get it from that one at that price, and when this one has that benefit, weigh them all out. Don't feel like you're pressured to go into one. But once we get into our early 60s to late 60s, this is where this generally doesn't start to become a good idea. So if you do get long-term care insurance, fun fact, that's going to be tax deductible. So make sure that you keep track of those long-term care premiums and then bring it to your tax advisor for that meeting. Insurance isn't about predicting the future, it's about transferring risk. Number two, all right, so now that we decide I don't want to go pay the insurance, I'll just pay myself. Great, you got to have enough assets. It does give you this extremely flexible way of saying, hey, I want to do things my way. Just like Frank Sinatra said, right? You have full control over your money. You're not paying any insurance premiums, no policy restrictions, right? But you're gonna draw down on your assets to go do so. Your investments, your savings, your home equity, or maybe cash flow from your retirement income. It puts a lot of strain on those things. The pros are nice, but those cons are heavy. And home care is expensive. Market timing matters. If we go into a bear market and all of a sudden you need into it, now you're drawing down on your investments in a down market, it's a huge risk to your financial plan, to your financial security. And plus you got to have substantial assets to go into this mantra just to have that kind of thinking. This is easily a 7-figure club to kind of go into whether or not if I have enough for a long-term care event. So when running financial plans, it's not a bad idea. I kind of like to run them at least a 10-year minimum. Granted, it may be less, it may be more. Individual experiences will vary, but at least with a decade, it gives us enough expenses where, it's a good buffer. And just saying I will pay for it without having a plan really isn't a plan. If you're going into retirement, you definitely need to have a financial plan to really kind of help guide you through that decision-making process of we're going to be intentional with us not getting long-term care insurance. And if we have enough assets to do it. So that way I don't go burning all my money in Cabo and Bora Bora because I know I need to keep some in the hopper in case doomsday comes around the corner. So we covered the first 2 doors. Now it's time for door number 3, family. You can count on family. Blood is thicker than water, right? However, one, it puts a lot of stress on those family members. It can create strain that affects careers and finances and ultimately change those family dynamics. It's not a simple ask of just letting mom and dad move in. It's your whole family situation going to take place. I remember when my grandfather moved in with us, and I was just, some teenager in high school, not really understanding the nature of why he was moving in, and eventually it graduating to hospice and all that really meant at the time. But it did change my relationship with my grandfather. And ultimately I look back on it and I analyze how my father interpreted what was going on in his relationship with his dad, and ultimately some of the career changes he made to accommodate it. Ultimately not the best thing for him, but he did it so he could be there and take care of his dad. It wasn't wrong. It was a choice that needed to be made, and he chose to be there. It's always going to be a conversation. Who's going to provide the care? How long? What support will they need and have? How are the expenses going to be handled? The worst plan is the one that's not spoken of. So if you're thinking of, I'm just going to offload myself to the kids, that's a conversation that you need to have. Or whether or not, are my parents expecting that of me? What do I need to do to get ready for this transitional state? So, putting it all together, I would say most people just don't choose one. Sometimes it's a combination. We have some minimum amount of insurance, then we're gonna have our savings a little bit over here, and then maybe your kids are able to pick up the slack to some degree. Maybe it's all 3 of them, maybe it's 1 or 2 of them, but long-term care planning isn't about fear, it's about preserving choice, dignity, and relationships. So if you're gonna take one thing away today, let it be this. Long-term care just isn't about you. It's about who you don't want to burden and how you want that chapter of life to look. Thank you for joining us. And remember, this is all educational. Please talk to your financial advisor about any planning opportunities here. Thank you and have a great day.